Good morning, traders. I'm going to try to keep this first section fairly short. Today is October 1st. It is fairly early in the morning. We are looking at the E-mini S&P weekly chart. We've got a lot of volatility and rotation taking place over here. We've got a lot of volume showing up. And I want to just highlight my primary count in yellow from these lows, the 2009 lows. Get back over here. And show you that I'm estimating this to be A, B, C formation up to here, attempting to find a D formation here, and then potentially rally upward into a new wave 5. Now, initially, I had projected a broader A, B, C formation. I still think we could be in that phase, but I think that we are very likely to move into a fourth quarter rally here and attempt to find support, which is why I've been looking around at various phases. Now, two things we're going to look at first. From the wave 2 bottom right here to the wave 3 high right here, we have a very interesting projection at a 382 level. Let me expand this out so you can see it. A 382 price level at right here at 3665, 3666. We have just gotten below that level. That's the primary support level that I've been drawing here with this green line. Even though I hadn't identified this as a Fibonacci, I had drawn this green line as critical support off of the June lows. I believe those June lows are still critical. I also believe that this next level right here presents a very, very valid range for price, which is the 35.15 roughly level. Now, there's some other things that I want to try to point out. I've also been drawing extended lines. You can see them, and I will try to extend this one. Extend to the right. And these originate off of the 2009 low, the 2003 low and the 2009 low. And what we're doing is we're measuring levels from these high peaks, and in this case from these two highs and this low up to this low right here. What we're doing is we're trying to project the initial wave forward to identify where support may be found and where we may be seeing some underlying Gann angles that come into play. What's particularly interesting is that this lower level here off of the 2000, this was the 2011 to 2014 rally phase before we had this slight little blip, carries forward very, very close to these June lows, and that these highs here from the 2010 high up to the 2014 high carry across to where I believe we're going to find ultimate support. This last level is much weaker. It actually shows a deeper level, which could come into play, ladies and gentlemen, but we're not quite there yet. So as we play this forward, as I've been telling you, it's very likely that we are seeing some sort of extended, what happened to my chart? All right, let me get this back over here. Extended rollover in the market. So here we have the blue line from the lows in 2012 through 14. And it comes right past the June lows right here. So we're below that level right now, slightly extended. We need to see it move back above that level if it's going to try to hold support. Then we have the high levels from after the 2009 bottom coming right across this level here, which would put us out in this level. Remember, this was the area that I was predicting originally would ultimately become support. And that's why I've got this green box here. I believe this is very, very likely to become very critical support where we might see, we're down in this level right now. Let me spread this out a little bit. And you can see that we're down in that level right now. We're just getting into that support level. And we only have about 60 or 70 points to go lower before we hit this deeper middle yellow level right here. And then we have this upward support level, the green line, which is the green line from the 2012 and 14 highs. I believe that the markets are shaking out the fear that is taking place throughout the world, and the U.S. markets are likely to change direction. I believe the Fed is about to slightly pivot, possibly pause. Possibly by October, November, we might get news that the Fed is concerned and willing to let things stay where they're at. Maybe a quarter, maybe a half a point rate hike, but I don't think they're going to go with a 3/4 point rate hike right now. I think they've already moved things enough. I believe that the U.S. markets have washed out sufficiently down to that initial support level that I predicted to take place, which was, again, just above the pre-COVID levels. So here's our COVID levels back over here. I believe we may move down to this yellow line over the next week or so before we find real support. But I believe that we're nearing what may be the end of an unwinding phase, especially as we move into Q3 and end of Q3 and beginning of Q4. What I'm expecting for Q4 is a little bit more consumer engagement, a little bit more positive news, Fed to potentially pause or weaken their rate increases, trying not to create another Lehman moment or global financial crisis moment. And I believe that's going to be interpreted as a fairly positive move for the markets. I also believe that earnings, Q3 and Q4, will likely continue to surprise investors, meaning that I believe that you're going to see some industries have some sort of contraction related to commodity costs, energy costs, shipping costs, what have you. But I believe that the U.S. markets as a whole, just like last quarter, will continue to prompt moderately strong earnings and expectations going forward. Yes, they may be a bit weaker than Q2 levels, but I think they're still going to be relatively strong compared to what's taking place throughout the rest of the world. Let's take a look at the Nasdaq real quick. So now you've got my feelings on everything. I've got a lot of drawing on here from last week. Go ahead and get rid of a few things here. I need that line. I think that's about it. Yep, that looks like about it. Okay, so the Nasdaq is again broken through the June lows right here. We're coming back down into this red level low here, and that's again right into my projected target zone. I had originally warned that we may see a movement back down into these levels yet. We're not quite there yet. Just for the heck of it, let's come back over here and extend all of this out. Oh, a little too much. Server's acting a little slow. So we've already got some lines here being drawn from the highs and lows, the yellow line here. Let me readjust this one to the lows. So I'll just draw a new one. And if we were to take these lows back here and come across this low here, we still don't have anywhere close to where we're at. So we don't have anything here. We don't have anything here. It's not going to be of any real reference. So understand that the Nasdaq has already rallied well above these levels, moving into a parabolic step. Now what we can do is we can take a look at this from a Fibonacci standpoint, from these lows back here up to these highs. And what we're looking for here, ladies and gentlemen, is correlation of the pullback. So I'll come out here, take a look over here at these levels. We are down below the 382 level. We are just below the 50% level. So we are just below the 50% level, and a 10,016 would be the 618 level. So we are right now, this red line, this 10,953 is acting as primary support for the Nasdaq. We will have to see how the Nasdaq holds up. Obviously, it's trending downward. Let's not fool ourselves. That's why we've already moved into a protective stance with the Ment rotational modeling system. I'm not urging anyone to try to buy this. I'm trying to tell you what I see as intermediate support on these longer term charts, with the potential that we're getting very near to an end of cycle. You can see this end cycle here in green. That's going to come next week and the week after. So we are ending an end cycle on October 10th, which means we could put in a fairly strong bottom in this area. And we could see things change moving into Q4 of 2022. Now let's take a look at gold. Gold rebounded last week moderately. I mean, it's nothing to shake a stick at, but it was still on a weekly basis. It was still up off of these lows, which is a very solid move. I still like gold overall. And the reason I like gold so much is because on a weekly basis, it's moving quite extensively. So hypothetically, we've got a couple of very interesting things here. Let me get rid of some of this drawing. That happens, I'll have to remember to clear them. So from these lows back here, where we had these double lows up to the current high, let's go just to this current high right over here. Gold right now is just below the 618 level. From down here, which is the 2018 lows, up to the current highs. Get my mouse to cooperate. We are, and let me drag this over, we are just below the 382 and right at the 50% level, right at this yellow line. So that's why, again, one of the reasons why I really like gold. Now, gold, let's take a look here. Okay, so hypothetically, if you're trying to become bearish with gold, I want you to focus on essentially this. We have a deep, deep bottom, okay, way back over here. And we can count this theoretically as a big wave one coming back down here into multiple waves. 2, 3, down. So that becomes 1, A, and then A, B, C to 2, and then all the way up here to 3, back down here for 4, and now we're in the midst of a broad wave 5. And I believe the broad wave 5 is an ABC correction, likely to attempt, let me get rid of this, try it again. The wave, the corrective wave here from what I am calling 4 down to here is going to be a 5 up to the peak, back down to here where we're at, and then essentially up to potentially here. So this is why I really like gold and silver. And as long as it's able to hold above these support levels and transition as the US dollar weakens, I very strongly love the idea that gold and silver are doing what they're supposed to be doing, acting as a safe haven. The strength of the US dollar has been dominant, and gold and silver have been holding up fairly well. Silver not so much, gold more so. But I still strongly believe that gold and silver are primed for a big move higher, particularly once the US dollar changes direction and the US Fed pivots into a more softer stance. This is a tremendous opportunity in the long run, because if you take a look at these extensions from this low to this high, if we were just to move from these lows back here up to this high here, and understand that that is from a percentage standpoint and price standpoint, it's a 650% move. And if we were to try to duplicate from this level here up to a 650% move, we would, even if it were to attempt an equidistant move, or potentially, let's say a 350% move, we would be looking at about $4,500 gold. And that would be half of this move. So understand that depending on how we need to count this and how we would count this, we would need to see if this is a new wave 1, 2, 3 formation, or if this is a 5-wave formation from back here. This could very well be the end of a wave 5, then an A, B, C downward move, then an A, B, C upward move, and C cannot be smaller than A. So if we count this as A, wave C cannot be smaller in price size than A. That means we have at least a $1,600, let's call it $1,700 move, which would put us up here. So 1620, we need to move that a little higher. Come on, mouse. There we go. Let's put it right in there. So that puts us at gold at around 2,900. So understand that this is one of the reasons why I love gold right now. I think things are shifting, and I think long-term gold and silver, 5, 6, 7 years, could be a stupendous move higher. Let's take a look at silver on this monthly chart. All right, silver's got the same type of setup. Real quickly, we have this big move here back in the 70s. And let's call that a big spike up. You can almost see an A, B, C move right there. Let me get rid of this. Try to do this a little better. A, B, and then a huge parabolic move all the way up. Then we get a very clear A, B, C move down, followed by a retracement, followed by an A, B, C move down, it looks like, followed by a new wave up to here. Kind of convoluted, but I would count that as A, B, C, and then a corrective wave back down to here, and then we get a, looks like an A, B, C move up to here, which is 2011, and where we're at right now, when we take a look at this move downward, we have a fairly easy A, B, C, D, E, although this is not deeper, so I would call this A, B, C, D, maybe E down to here, although that C wave couldn't be 1, 2, no, this has got to be A, B, and then 1, 2, 3, correction, 4, 5, 6, so there's our base, and this is a big extended wave here from the C wave actually moves to here, then to here, then to here, then to here, then to here. And that's, or potentially to here, A, B, C. Then we have this base setting up an impulse move, A, B, now C, now corrective wave D here, C. Actually, this is a new low, so this has got to be a, so this has got to be C, this has got to be D, and this has got to be E down here. So that means that we have new wave A here, B down here, moving into this pennant formation, and now C cannot be smaller than A here, so C would have to be at least up to about here, possibly much higher, and then a corrective wave, and then another 5-wave up. And that's why metals are so positive right now. Others are warning that metals could collapse. And yes, I will tell you that metals could collapse, but I don't think that it's likely to happen as long as we stay above these support levels. We've got this blue support level and this base level here. If you follow the counts, it is very simple. We've got an exhaustion bottom here. So ideally, the next wave is legging up higher. Understand that everything is legging into these upward moves. Once we get these bases, for example, like here, then we move up higher, form a new base across here. Then we move up higher, form a new base across here. Then we extend higher. So now, over here, what we're having is the extended base right here. We've got this base, we've moved up higher, we extended out, and then broke to the upside. Now we're getting the same type of an extended basing here, and then we'll likely break to the upside. Then we'll get that extended basing again, and then break to the upside. And what this is telling me is that there's an absolute amount of fear that's taking place throughout the world, chasing after US dollars, and likely moving into precious metals in a form that we're just not seeing yet. What I can tell you is global banks have reporting a run on precious metals. People are accumulating physical metals faster than ever before. And even though, like I said, from the paper market, or what's called the spot market, you may see some very interesting moves in spot price. You need to understand that the core element of the markets is a prediction of whether or not global central banks are going to be able to manage and handle the activity that they've set up related to capital functions, credit markets, and overall concerns with the credit and debt issues. So right now, a pivot by the central banks and a weakening US dollar, which will likely go hand in hand, will likely send precious metals into a perpetual bullish trend. Give you an example. This move back over here, I'm trying to get rid of these drawings that I keep drawing all over the place. These moves didn't happen here until after the bottom. So understand that we started seeing this rally phase here as credit markets went a little crazy, kind of like we're seeing right here. Credit markets have gone a little crazy after COVID. We've seen this rally phase here, very similar to kind of what happened right over here. In fact, you could argue that we're in this deep phase here or this deep phase here right now, moving back up into these highs to stall out. But what ended up happening is when the markets did finally break down in 2008, 2009, gold collapsed with it, assuming the markets were to collapse. Then when the Fed pivoted and went into softer, easy money policy, metals skyrocketed on the fact that they were unsure of what was going to take place, and everyone was moving into the safe haven assets when the Fed moved into the quantitative easing phase. Now, understand that as central banks move into more and more central banks move into the lender of last resort to perpetuate the opportunity of easy money cycles when they realize that interest rates above 3.5% to 5.5% are going to be very dangerous for the economy. The Fed may pivot back into more of an easing stance, and that could send metals strongly higher. Demand for commodities is already collapsing. Oil is down, even though in California, gas prices are now above $6 or $7 a gallon. Gas has already started to collapse. You can see it here. And I believe natural gas is going to settle back down around this $74, $76 level and eventually move back down to this $63 level. Possibly by the end of this year, more than likely into early next year. We'll see how everything plays out in Europe with regards to disruption of delivery and supply. We're in a downward cycle trend, and this is mostly because the inflationary pressures are really putting pressure on consumer demand right now. And as consumer demand weakens, you're going to find that prices come down. The issue in California is we're having a refinery go through a bunch of major repairs, so our gas prices have shot up about $1 in the last week and a half. It's been kind of frustrating, but we deal with it. We just plan around the cheaper gas stations and try not to make excessive trips. All right, in phase 2 of this, we will go over the custom indexes and the Ment rotational modeling system and a few other things. Follow along, guys. Here we go. All right, traders. Now we're moving on to the TTScanner Hotlists. These are the weekly hot lists using my proprietary TTScanner application. These are for you to use as swing trading applications. They are designed to be slower, 2 to 50 weeks or longer in length. We're going to go over them. I'm sorting them differently. I'm sorting all the new triggers up here. And then this way we can see them all together. They are sorted by entry price from smallest to largest in most cases. But I'm trying to coordinate this so you guys can see what's going on. We have, in this case, this is our regular TTScanner Hotlist weekly. And you can see we have a number of short triggers. Last week we had a trigger in Jets that had an entry trigger at 57.37. We're already 2.34% in the profits. Moderate downward thrusting. We had a continued trigger 1 week old from REIT, R-E-E-T, already up 9.9%. Beautiful, hit our first profit target. We had a short trigger in GDX, 12 weeks old, hit one of our profit targets. Is getting not so close to our second profit target, but still moderately downward. The positive thrusting level here, instead of negative, indicates that things are moving a bit higher. So we may get stopped out of this trade if it continues a bit higher. The next trade is on GD on Nugget. Same thing. We are short 12 weeks, 27.82% profit. Hasn't hit our first target yet. And we have positive thrusting, so we may get stopped out of this, but we have a 27% profit in the trade. Next is Gdxj, 13 weeks old, 16.24% profit, hit our first profit target, and moderately positive thrusting pattern. Next is IGF. It's a new trigger from last week, last Monday, 4.28% profit, has not hit any targets, still strongly bearish on a thrusting pattern. GNR, Global Natural Resources, is a new trigger last week, minus 2.34%. Still moderately bearish on a thrusting pattern, has not hit any profit targets. XLC, we have a short trigger, 1 week old, 7.41% profit in the trade, no targets hit. Moderately strong bearish, negative 47 is pretty strong. XLE is a long trigger, 37 weeks old. It's turning around, ladies and gentlemen, as you're aware. Our stop level's at 65.32. We got in at 61.48. We've already hit these two profit targets. Well, depending on what happens here, we could see the stop move up and or get stopped out of this trade. We had gotten quite a bit more profit in this trade, but we're still up 17% in this trade right now. IXJ Healthcare, short from 1 week ago, 4% profit. And we have moderately downward thrusting. We have a short trade here in QTech. It's a brand new trigger from last week. We have 1.98% profit in the trade. Moderately downward bearish thrusting pattern. XOP is a long trade, 33 weeks old. And again, set up similar to the XLE trade over here, although we are still negative in thrusting. This is a long trade, and we could get stopped out of this. 124 stop is at 107.75. We had seen quite a bit of profit in this, about 15, 20, 24% roughly, but it's now rotating back downward. SOX, S-O-X-X, sorry, IYH is the next one. New trigger, 0.4% profit, thrusting downward. And SOX is a new trigger from last week, 3.65%, thrusting downward as well. So you can see we've got quite a bit of profit in these. One losing trade that's from last week, minus 2.34%. But this is the real value of TTScanner. TTScanner is going to catch these things. They're weekly, so they're weekly swing trades. They can last 2, 10, 15, 20 plus weeks. And when they're right, you're going to see it turn into profits fairly quickly. And when they're wrong, you're going to see it get out of a position fairly quickly. Let's take a look at the core list. This is the core ETF list, which is available on the Trade Tank website for all of you members. We've got a number of older triggers. Let's see if we have any newer ones. Here's a new one. Let's just go through them. MJ has been 20 weeks old, 41% profit, already hit the first profit target. It's only 50 cents away from the second target, thrusting downward. DBA, 75 weeks old, already hit the targets. It's 14 weeks, 14% in the profit. We've already seen quite a bit of profit in this trade from where we got in, 1755. But this is rolling downwards, a very long trade. We've been in this for a year and a half. IYZ, 2 weeks into the trade, 16.58% profit. Hit both profit targets already, thrusting downward. It is a short trade. UUP is a long trade, 24 weeks, already hit both profit targets, 12.84% profit in the trade, and still thrusting moderately upward. Next is GDX, is a downward 12%. I think we covered this on the other side, 12.86% profit, 12 weeks in the trade, thrusting upward slightly. Red, it's still a red color, but it's thrusting upward. Next is UGL, ProShares Ultra Gold. 4 weeks old, 9.09% profit, already hit the first profit target, which you should have pulled 1/3 to 1/2 off. So hypothetically, these should be 1/3 in the first target, 1/3 in the second target, leaving 1/3 to go, or 1/2 on the first target, 1/4 on the second target, leaving 1/4 to trail. So again, holding up okay. This is a short trade, strongly moving downward is what it says. XLE is a long trade, 37 weeks, 17.14%. This is again as of Friday. ARKW is a short trade, 21 weeks, 28% profit. We have not hit our profit target yet. We're still about $1 away, $1.40 away from our first target. May never see our second target. This is a very big target. And then XOP is a long trade, 33 weeks, 12% profit. And we've been in this trade for quite a while, may get stopped out of this. But again, very strong numbers, ladies and gentlemen. I mean, it's hard to argue with 15, 20, 30, 40% profit on these swing trades. I mean, it really is hard to argue. Let's take a look at this one, is the new core inverted list. We have 3 new trades from last week, so these would be a good example. One trade, EUM, which is up 23%. It's been in the trade 23 weeks, hit both profit targets, thrusting higher. DUST has been in the trade for 1 week. It's minus 6.82%, thrusting downward right now. A little bit of a warning, but still bright green, which is the strongest upward trending you can get. The next one is TBX, the short 7 to 10 year treasuries. It's up 2.54%. Been in the trade 1 week. And the next one here is TMV. These are treasuries as well, up 11.71%. Hasn't hit our profit targets. You can see how powerful this really is. This swing trading, if you allocate your money effectively and you follow this through, then you're going to do pretty well. And it's all right there for you. These change every Monday. Now, the targets don't change. The entry price doesn't change. The stop may change, but it's very, very simple. You set your trade up. You run it as a simple trade with an entry at the entry or close to the entry. You set your target however you want, at a half or a third. You set your target to at a quarter or a third. And you set your stop as a fixed stop at this current level, and you let it go. And it basically just rolls right through these trades for you. Kind of hard to argue with all these positives. Oh, we've already seen this one. So last one is the value list. I have to zoom in here on the value list because it's got a lot of symbols, so I have to run it kind of small. So first what we are going to do is we'll look at WBA. It's been in the trade for 4 weeks. Hit its first profit target. It is a 12.66% profit with moderate downward thrusting, which is what we want. When we're in a short trade, we want to see downward thrusting. The next one is Intel. Let me try to move this over. See if I can shrink this a little. All right, I'll just try to read these. Intel Corp, been in the trade for 13 weeks, got 33.7% profit, and hit both targets. Moderate downward thrusting, stops at 33.48. Very close to this other one, actually. Very similar. Next is Verizon. We've been in the trade for 7 weeks. We got 15.53% profit, hit the first target, and stop is at 43.49. Next is Dow Inc. We are short, been in the trade for 2 weeks, 3 weeks, 11.96% profit, hit the first target, stop is at 47.46. Next is SMG, Scott's Miracle Grow. Been in the trade for 1 week. We have 20% profit. Gotta love it. That's just a fantastic profit. Hasn't hit any targets yet. Strongly downward thrusting. ALE, we got a new trade last week, 10.2%. Looks like 10.26% profit. Hit the first target already. Stop is at 54.02. Very strong downward thrusting. Manpower Group, short trade 1 week ago, almost 7% profit. Next is Hasbro, been in the trade 1 week, 9.78% profit. EMN, Eastman Chemical Corporation, been in the trade 1 week, 9.919% profit right there. I mean, follow along, guys. These profits are just waiting for you. Nike, yep, we've been in the trade for 1 week. We've got 20% profit. JP Morgan, we've got the trade just on Monday, 3.24% profit. Chevron Corporation, been in the trade for 38 weeks, 22.36% profit. Hit both targets and thrusting downward. MMM, 3M Company, 2 weeks old, 11% profit. Loving that. Salesforce, CRM, short 1 week ago, 4.56% profit. Caterpillar, short trade, new trade just last Monday, negative 0.05%. So again, out of this entire list, this is our first little loser right here, and it's only 0.5%. Visa Corporation, short trade last week, 2.94%. And then United Healthcare Group is a long trade, 76 weeks, 34% profit. Gotta love how this sets up, don't you? I mean, really, these swing trades, the value of what is here for an active trader to be able to swing, $5,000, $6,000 each into these trades and to get, a 10% move is a $500 win. A 20% move is a $1,000 win. A 5% move is a what would that be? And do the math real quick. A $250 win. And this is listing 10 or 15 of them here that are just phenomenal, great swing trades. I hope you guys see the real value here because this is part of what I'm trying to deliver to you. It is free, and you almost can't miss if you follow the stop system and you manage your positions properly, you set up a cash reserve. In fact, I'll do a video on this week about how to do this and how you want to, break up your account into trading slots and allocate the money efficiently. I mean, obviously, you're 76 weeks on this one. We can't go back 76 weeks and buy it, but these new triggers and 1 or 2 weeks old, if they're close, like this one is a new trigger that's very close. This is a new trigger that's 3% that still has a ways to go before it hits its target, another $5 yet to go. Here's a new trigger that's already 10%, but if you get them where they're close, like this one, Visa, 2.94%, target looks like at 166, it's currently at 177. You could theoretically enter a trade here, run the stop, and execute this because it's a brand new trigger. These that have already hit the percentages and hit the targets, don't chase them. Just wait for a new trade setup. But again, how hard is it to see the real value of this? These are 10, 15, 20% or more swings on a weekly chart. You can set them up, walk away from them from a week, see what happens, come back and take a look at them next Monday. All right, in the next section, we're going to go over the custom index charts, and I hope you guys are really enjoying this because I do enjoy sharing my programming and my tools with you guys. It's really important that you understand the real value of all of this. Welcome to part 3 of the weekly update by Ment.com. We're going to get into these custom index charts to highlight kind of what's going on with the general markets from a high level view. These custom index charts are very, very helpful to gauge what the market's really doing versus looking at price charts. The purpose of these is to really understand how the market's reacting from a broad level. We're going to start with the Fangs Index and highlight the fact that the Fangs have already moved back into this standard deviation channel, which has historically been very deep lows into this low blue-green area. So right down here, we're getting very low in the technology index, and I'm going to show you how deep this has been, but it looks like the technology sector in the U.S. market may be bottoming, maybe changing into kind of an undervalued sector right now, deeply undervalued from a historical standpoint. This goes back to 2019 and 20, but as we get into earnings, watch how this might turn around over the next 2 or 3 weeks, move back up into this area or higher if earnings come out fairly strong. The U.S. stock market index has come back down into this lower channel as well. This is very deep downward channeling for the U.S. stock market. You can see the standard deviation channel going back from 2017 and 18. It's this green middle area here going forward. We kind of danced around that about 7 to 10 weeks ago, maybe a little longer, back in May and July and August. And then we recently just broke strongly to the downside once the Fed started raising rates aggressively and kind of burst the bubble with regards to a reflation trade, thinking the Fed was going to pivot. Now that the Fed has raised rates twice in the past 60 days, maybe we get some sort of a rebound from here. I'm also following this arcing, what I call the Fibonacci price amplitude arc, and I'm following this level because you can see this breakdown here followed down until we hit this line and then bounced back up. Then it moved down this price amplitude arc, and now we're at a deeper level here. I'm very, let's say, interested in the potential that the U.S. market is deeply undervalued right now. We may get some sort of a dead cat bounce or a Christmas type rally moving forward. So we need to see how this goes playing forward. But I'm very strongly anticipating some support above these pre-COVID highs, which is this blue line. And I think we may be very close to an intermediate market bottom. One of two things is going to play out. Either something is going to break and then the markets are really going to collapse back down into these COVID areas, into maybe this area back over here, this red area, or we're going to see this level kind of hold and prompt some sort of an upward movement. And I'm leaning more towards an upward movement right now. But remember, we're still very cautious overall. Next, the Smart Cash Index is broken downward. This is related to China, Asia, and Europe. We've seen this big, strong breakdown. At this point, ladies and gentlemen, it looks like it's targeting these lows, these COVID lows. Could very well happen next week off of extended selling. We'll see what happens. And this could be what's breaking the global central bank's anticipation, particularly the Fed, of raising interest rates, the damage it might be doing overseas to create a global type of a Lehman moment. But again, we are in a strongly downward trend right now, looking for a bottom. So there's really no reason to try to buy into this yet, other than the fact that we're strongly devalued. Okay, metals broke through the support area that I was trying to predict was going to be a holding area. We still have a secondary support level through the midpoint of the pre-COVID highs, pretty much where we're at down here off of these lows. I showed it to you earlier in part one. I am still strongly believing that metals are deflating through this Fed rate increase and the strong U.S. dollar, but in a moderate uptrend. Given our exposure to metals, which is very low, I still believe that it is an excellent hedge against a sudden change in market dynamics. And if you read between the lines with what's going on in bullion exchanges and the amount of actual physical buying, everybody else believes pretty much the same thing, that metals are going to become a massive safe haven. So read between the lines. It is in a downtrend. It has been in a downtrend for quite a while. We have lost about 10 or 15% in true value on this custom index chart, from about 450 down to about 370. So about 100, maybe 20%. But understand that long-term, metals are up near extreme highs and are seeking out a bottom. My opinion is we'll know more by the end of this year. If you are unable to hold metals and are waiting for the actual bottom to set up, I understand. My personal opinion is I'm holding what I have, expecting this to change over the next 6 to 12 months and to become a very solid buy trigger. Now remember, a lot of the metals that I was buying, physical metals, was back in 2013 and 14. So I have a base price for silver, for example, of around $12, $13, and gold of around $15.50 roughly. So I'm holding for quite a while here. Okay, the valuations index has really wiped out. It's kind of very low. I don't know how to say it any other way. This is an extreme washout kind of a pattern. We haven't been this low since back over here in the bottom in 2018 and the actual Christmas lows back at the November, December 2018. We are at historically very, very low valuation levels. This is why I think we're getting very close to a bottom. We could see this blow out downward and stay in this downward area for quite a while. No lie here. The reality is this could extend downward for many, many months throughout the end of the year and into next year. But I really believe earnings are going to be what drives expectations over the next 6 months and what the central banks do. It's going to be very key to hear what the Fed says this month and hear what they are expecting with related to continued rate increases and inflation. Based on everything I'm seeing here with the valuations index and many of these other charts, the Fed's already pretty much beaten down inflation. It just needs to unwind maybe another 10 or 12 months. And that's why the Fed would be very risky to try to make aggressive moves right now. Commodity to gold index, again, wiping out down near these extreme low COVID levels. And again, back here, the end of December, extreme low levels. This was December 2018 when the markets had reached kind of an ultimate bottom and then rebounded. We're right back there, ladies and gentlemen. We're right back near these COVID lows and these extreme lows, which tells us that the markets have unwound quite complete. I'm not saying they're done, but I'm saying that it looks like they're about 80 to 90% unwound right now and could be very, very close to a bottom. We need to see what happens, what the shift is, whether it's going to be Europe, whether it's going to be China, whether it's going to be the Fed. But the unwinding of the excesses in the markets have already, it seems like, taken place. And now we're just waiting for some kind of a shift in the other direction. And the volatility index has moved downward, 5.89. You'll see in my written report that this is moderately bearish. We've seen this type of move before. We saw it back here. We've seen some moves back over here, just moderately bearish. This was the low, the December 2018 low. You can see how it got down into these low levels and then basically rebounded back to the upside. Back over here at early 18, rebounded back to the upside. Is it going to do the same thing now? Is this the washout low and it's going to rebound back to the upside? We'll see next week and over the next couple of weeks. My assumption is it's either going, well, my assumption is it's going to move back higher. That's what I believe is going to happen. But on an alternate, let's call it a plan B, is we could see some sort of a big washout moving back down here to 4.5, and then attempt to find some sort of a recovery phase back out of it. These have historically been very solid basing and bottoming patterns when we get these types of rebounds. What extends us into a bearish trend is when we get below this 6 level with a very strong close and then can get a continuation bar to the downside. Then we start to see some real washout lows. This was COVID, and we haven't quite got there yet. This is really kind of just you think about it, this is a capitulation, fear, selling mode in the market where nobody really wants to hold on to anything, anticipating the Fed's going to do another 3/4 point interest rate hike. Kind of leaning towards the fact that the Fed is going to move away from that going into the end of the year and try to be a little bit more cautionary going forward. And that's the end of that. Now let's come back over here and go to these charts. So here's the custom volume ratio. Very flat last week. We didn't have any real big buying opportunity, obviously. Still not negative. I've highlighted these peak points because I want to highlight the scenario that takes place during these peaks. We get these big bouts of buying, then we move into moderate selling. Big bouts of buying, move into moderate selling. Right now, we're in a kind of a deeper low with the markets. We're not seeing really any capitulation, but I'm assuming we're starting to see some accumulation. I believe smart traders are starting to buy near these lows, anticipating that the Fed does not want to create a massive Lehman moment and end up having to dump another $6 trillion into the market to try to save the global financial markets. The custom U.S. to valuation trend index has been a very solid indicator, and you can see how this has post-COVID rolled over into kind of an A, B, C type of move. We're still holding above this purple line. I would not be surprised to see some sort of a rebound in this level back up into this 255, 240 area, up into this area. But long and short of it, we are still in a downward trend. We're trying to hold support. Support is apparently holding, even though it's not apparent on the Nasdaq or the ES price chart. We need to see how this plays out over the next couple of weeks, and if the Q3 earnings and Q4 anticipation shifts into a Christmas rally. The custom large cap index is holding up quite well. September selling pressure really didn't move this too much. It looks like it's flattening out, very similar to kind of like right here. And this was the end of 2018, the December 2018 move, or here, the end of 2017, where we had this flattening area. I believe this flattening area could roll around in October, maybe slightly higher, and then possibly attempt to move back up to this 120, 123 area on a Christmas rally. We'll see. But we're definitely not seeing a bunch of massive selling pressure. We've seen decent selling pressure, like this little dip right here, right back over here. And now I think we're going to see it roll back to the upside. This is a monthly chart, and start to see some sort of an upward move here. At least I'm hoping so, based on what I'm seeing. The U.S. to global market index, the U.S. market in blue, global markets in red. You can see the global markets have really washed out. And that's what we're seeing, is this is more of a global event than it is a U.S. market event. The U.S. market event, or U.S. market trend from 2017 till now, is up 44% still, whereas the global markets have rolled into negative trending from 2017, and that tells you that Asia, Europe, and pretty much the whole rest of the world is having a bit of an issue, whereas the U.S. market is holding its own, and that's because the U.S. market has been somewhat immune from the contagion events that are taking place. We still have a fairly strong economy. We've put into place protection in our financial system with the bank stress tests to make sure that we can handle things. And the Fed rate increases really hasn't destroyed the housing market or consumers yet. It could still happen, but hasn't happened yet. But the global markets themselves, they're in some trouble. And that's what I think the Fed is really watching right now. The global asset index is holding its own. It's still a little bit weaker, still dancing down around these lows. You can see this has been in place since after COVID. And what I want to highlight here is that we've not seen a lot of real growth over the last 2 years in this index. Whereas we saw this big growth in 2019 and 20. We saw some more growth back over here, 14, 15, 16. We're not seeing any real growth phases yet. What would happen, what I believe is going to happen here is that we're going to see the devaluation kind of settle down. The markets themselves will settle. Fear will settle. Global central banks, China, Europe, what have you, will move into a more neutral stance, trying to make sure they don't knock the train off the train tracks. And we may see a moderate recovery in 2023, in Q4 2022, and into early 2023. We'll see what happens. And skip this one. The gold cycle index moved higher, as well as gold moving higher. Remember, the metals index moved slightly higher. This is very positive, actually, for metals. We need to see what's actually going on. Remember, 2011, when we had the peak, we were down in this area. What we need to do is we need to see this start to move higher as we'll start to see these bottom. This is going to indicate a major bottom in metals, and it's going to start to really form a solid rally. Remember, 2016-17, we saw a rally, and in 2020, after COVID, we saw a rally. That's right in here. So we need to see this do what it's going to do, but ideally it's going to move a bit higher, and then it's going to start to rally back down, and that's going to be when metals really start to take off. The Consumer Engagement Index. This is something that I really love to follow. Consumers are moving back into the market, and you can see in 2017, November 2017, consumers moved back into the market and drove a trend. After COVID, consumers moved back into the market, drove a trend. 2014, after a downward trend, consumers re-engaged and drove a recovery cycle. Is that going to happen now? I think so once we get above this purple line. If consumers re-engage through Christmas, start spending some money, start buying retail, start doing what they normally do, we could see consumers re-engage. We could see a moderately solid end to 2022. But we're not quite there yet. We're getting close, but that purple line to me is really re-engagement, and then we start moving higher. The Technology Ratio Index shows us that the technology sector is very flat. It's pretty much bottomed out, guys. I don't see how this could go much lower. We're already back to 2014-15 levels, and if it were to inch a little bit lower, we'd be going all the way back to 2011 and 12 levels, which is, just after the market bottom. Yes, it could break down, but I really do kind of believe that technology is extremely undervalued right now. May be a great play over the next 6 to 12 months if we pull out of this, but I'm not seeing excessive selling. This is one of the reasons why I highlighted the Fangs Index may be close to a bottom, and really this is another reason why I think the U.S. market may be close to a bottom as well. I think we've already seen the devaluation take place, and between this one, the Consumer Index showing consumers are re-engaging, and technology bottoming, I think we're moving into a new shifting phase where the U.S. markets may see some life, some upward bullish life back into them versus the doom and gloom I see predicted by so many other people. And I believe that's it. Yeah, that's it for these. Okay, so now let's go over to the momentum reversal system, and I need to resize this a little bit. So the momentum, let me start all over again. The rotational modeling system has not changed. Nothing has changed last week. The S&P-Y is still bearish daily, bullish weekly. So let me go through these. The SP, Transportation Index, Industrial Average, ES, YM, and crude oil are still bullish weekly. All the others are still bearish. So we're still in that neutral zone. Our allocation levels have not changed. We're staying exactly the same way, actively protected, protected in cash, protected in metals, protected in bonds. And what we're doing, ladies and gentlemen, is we're staying like this until we get some new trigger indicating a broad trend change. What that would take would be for the S&P to move into a weekly bearish trending or daily bullish trending. Either one of those would mean that we are now going to reallocate some money as we see fit, depending on what the trend is actually doing. Right now, though, we are still mixed, bearish daily, bullish weekly. So we are going to stay in this hedged position, and we are going to wait for the markets to do what they are going to do. The new position management window has a new update, which is that I have created this combined position right here. So if you are trading one account and you want to stay protected, it's going to basically be bullish, bearish, SPY, and an allocation level and cash. So what happens is typically we have a weekly signal and a daily signal. 25% of our allocation gets set up for weekly, 75% gets set up for daily. In this case, because we're bullish 25% and bearish 75%, that nets us to a 50% bearish position in the SPY and 50% cash. And that's essentially how we would be running it as a single position. Here's the current price for the SPY, which is populated here, here, and here, which I could probably get rid of these. I'll shorten these up to let you know what's going on. But here's our net position in this. So we're from our entry price of 610.2020 at 319.34. We've got 23% profit in this weekly trade. From our bearish trade on this daily chart of 831.22, we have got 9.62% profit. And from our net position of a net 50% bearish trade, 50% cash, we have got the same 9.62% profit in this trade. I just updated the, let me come over here and to here and reload. Nope, sorry. So I just updated this. Let me, I will show this to you here in a bit, but I just updated this as of the end of the month, end of the quarter. And what's interesting is this number went up to negative 4.72. We had our biggest gainer back in September of just this year, but it is holding its own. It's doing very, very well. And considering the S&P is down 24% this year, and we're down 4.72% this year, it's a phenomenal system. The Ment rotational modeling system is really doing what it's supposed to be doing, which is protecting against risk and providing very good hedging position for your long-term portfolio. So again, all of this is available on the website. Come and get it. I hope you guys understand the real value of everything that I'm delivering to you. Remember, the Ment rotational modeling system is an always-in strategy. This is where you should really have 75 to 85% of your capital is rolling in this type of a system, which is going to give you long-term growth and protection. Then, as you move down into your trading accounts, you should be using the, I don't know if I still have them open, I don't. Let me get them over here. You should be using the TTScanner for the next phase of your allocation. The TTScanner is for weekly trading, catching weekly swing trades, which allows you to catch some very big moves very easily and very consistently. And then beyond that, if you want even more activity and action, you should be back over here using the live trades system to try to catch and trade the short-term daily trades. And the point behind this is that you can, and this may not load because this was from yesterday. I will relog in real quick. So the live trades is where you catch the short-term swing trades. So if you really love the idea of getting in and trading, yeah, it does this, but it'll load. Oh, maybe not. There we go. So if you really love trading and you want to get in and trade swing trades, stick with the pure alpha trades and then come in here and you can take a look at some trades. I've gone through this so many times over the last week, but here's a trade, brand new trade in Apple. It's a short trade. Entry price is 142.40. We've got 2.84% profit in the trade right now. Ranking is fairly solid. That means we've got about 11 to 15% volatility in the market in Apple. But we've consistently, over the last 6 trades are winners. It's been very consistent over the last couple of years. This is a great trade setup, a little bit more volatile than I would like. So I might only trade a half of my allocation here. Here we have a trade in AVGO, $440 stock, 25 and 21% ranking, which means it's very volatile. 6 of the last 6 trades. So I would probably trade a third or a quarter of my allocation for this. BIIB, $266 stock, 6 to 5% So call it 6 to 7% ranking. Been a little mixed over the past couple of years, but 5 of the last 6 trades have been winners. I would probably only allocate 30, maybe 35% to this, simply because it's been mixed over the last couple of years. eBay has a 9 to 11% ranking. We got a new trades, 922 was a while ago. We got 3.9% profit. It's been doing pretty good this year. 5 of the last 6 trades are winners. Probably allocate 30 or 40% of my money into this. GILD is a $61 stock. We've got 5 of the last 6 winners. 6 to 7% of volatility ranking. Probably 50 to 60% of my money into this. We've got MDLZ, $54 stock from 930 just yesterday. And you can see it's been holding its own, not great, but 5 of the last 6 are winners. 8 to 9% volatility ratio, still ranking fairly solidly. This would probably be about 50 or 60% allocation level. PayPal, $86. It's been performing pretty well. 6 of the last 6 winners, bigger volatility. So about 50% of my allocation would go into this. But ideally, ladies and gentlemen, if you're looking for good trade setups and nice and consistent, then come over to Ment Live Trades, log into my account, your account, go to Live Trades and start looking around. There's some great trades over here. You just got to stick with the pure alpha and then take a look at them and look at these from a standpoint like ARKQ, a trade about a week old, 3.3% profit, been moderately consistent over the last 4 years. 5 of the last 6 trades are winners. Nice, easy ranking. This is what I love. A 4 to 6% ranking means that it's got very slow volatility. It's not going to kill you, and you're looking at a fairly solid trade. When you get into something that's got, like here, FCell, right here. We just got out of a trade. It's kind of been all over the place. It's got some big numbers, yes. It's got some big ranking numbers, yes. But that tells you that this is a very volatile stock. This could wipe out 40 to 70% of your capital or make 40 to 70% profits very, very quickly. So when you get these ranking numbers, these do not necessarily mean, hey, this is a great trade. It means this is historically ranking what you are seeing volatility-wise, okay? And that's seen here, 1.21. It's telling you that essentially you could see 100, 120, 130% ranking. So see here, these numbers, the closer they are, see how these numbers are so far off? 1.21 to 0.56 means you've got a big volatility difference. 1.54 to 1.28 means that you've got a moderately narrow volatility rank. And that's showing here in H-band. H-band is showing basically a 6 to 7% volatility rank. And that's going to be essentially what you're going to see here between these levels here when you take a look at this times 1.28 versus this times 1.54. What you're going to end up getting is about a 6 to 7% variance. So here you got one. So here's a big difference again between the volatility ranks. It hasn't been doing so well. It still has moderate support for this trade. 3 of the last 6 trades are winners. But again, use this system for daily swing trading. This is where you're going to find the best setups using these setups. And you have everything from bullish ETFs to futures, you know, all the way down here, NQ. We've got a trade that's set up here. Now, most people wouldn't take this, but it'll tell you what you want to try to trade from a standpoint of the market, and it'll also tell you how well the system is done. You can see here in the past these trades. 652 points, 520, minus 638, 341, minus 634, 451. This is a daily swing trading system on the Nasdaq, is what it's doing. So it's going to be catching some very big moves on the Nasdaq, not these little 2, 3, 20, 30 points. It's going to be catching multiple 100-point moves. All right, guys, that's it for now. Follow me on Twitter. Share me with your friends. Remember, all of this is free, and it's all designed to deliver you success. All right, guys, talk to you soon.